The topic for this webinar is using the tools of low-income energy efficiency financing for low-income solar. This is the second part in a two-part series on applying the lessons of energy efficiency to low-income solar. This webinar is presented by the Sustainable Solar Education Project, also known as STEP. This project is supported by the U.S. Department of Energy's SunShot initiative, and it's managed by the Clean Energy States Alliance. And our host for this webinar is Warren Leon. Warren is the Executive Director here at the Clean Energy States Alliance. Before I pass it over to Warren and to our guest speaker for this webinar, I'd like to go over a few quick housekeeping notes. All of our participants for this webinar are in listen-only mode. You have a couple of options to join the audio portion of this webinar. You can either call in using a telephone, or you can connect using your computer, mic, and speakers. A very important note, we ask that you please submit your questions as you think of them throughout the webinar by typing them into the question box on your webinar console and hitting send. We will be reading through your questions as they come in, and we're going to save about 15 minutes at the end of our presentation for a Q&A with the audience. So to make sure that we get to your question, type it in when you think of it. Don't wait until the very end. A final note, this webinar is being recorded. You'll find a recording of this webinar as well as all of our previous webinars, including the first part in this webinar series, on CESA's website at cesa.org/webinars. So with that, I will pass it over to our host for this webinar, Warren Leon.
Hey, thanks very much, Samantha. This webinar is being hosted by the Clean Energy States Alliance, and we are a national organization of public entities working together to advance clean energy. Most of our members are state agencies, and you could see logos of some of our members up here on the screen. If we could go to the next slide. Through the Sustainable Solar Education Project, we are focusing on outreach to states, municipalities, and a wide range of other stakeholders on two topics. One is strategies to ensure that solar electricity remains consumer friendly, and then the second is strategies to ensure that solar electricity benefits low and moderate income households. This is part of the SunShot initiative. As Samantha mentioned, we do a monthly newsletter. We do webinars like this one. We produce program guides, and if you want to get on the mailing list, go to our website, CESA.org, and sign up for the Sustainable Solar mailing list. And if we could go to the next slide. We're having our system's a little slow here, but good. We're going to jump right into our presentation in a second. As Samantha said, this presentation is going to focus on what are the lessons learned about energy efficiency financing, and the hope is that those folks who are interested in developing solar financing programs for low-income audiences can apply some of these lessons. And we're lucky to have with us today someone who's very knowledgeable on this topic and has studied it deeply, and that's Greg Leventis, who's a program manager in the Electricity Markets and Policy Group at Berkeley National Laboratory. Specific focuses included efficiency finance, cost of saving energy, and incentive program design and analysis. Utilities Commission, and he has advised the San Francisco Public Utilities Commission. Member of the Finance Subcommittee of the Alliance Energy's Policy and Programs Committee, and he holds a public policy from the School of Public Policy at the University of California at Berkeley. Greg is going to, and then there'll be time for your questions, so type them in. Greg, all yours.
All right. Well, thank you, Warren, and thanks to Clean Energy States Alliance for the chance to share some of the work that we at Lawrence Berkeley National Lab have been doing. A lot of what I'm going to share with you today is based on work that I've done for Department of Energy's Weatherization and Intergovernmental Programs Office, and also DOE's Clean Energy for Low-Income Communities Accelerator, which we have been calling CELICA. So the Clean Energy for Low-Income Communities Accelerator is a program that's part of the Better Buildings Initiative, through which DOE partners with state and local officials, corporate CEOs, utilities, and others to make commitments to improve energy efficiency of their buildings. So Accelerator partners collaborate with DOE to demonstrate successful models for expanding the installation of efficiency and distributed renewables in low-income communities. Some of the goals are to ID ways to overcome market barriers to clean energy and adoption, in low-income communities, to share solutions, resources, and technologies that help these communities adopt clean energy, to demonstrate successful partnership approaches for integrating clean energy in low-income communities, and to increase visibility and replication of best practices and successful models. Today, I'm going to talk about three things. What types of financing are being used to pay for energy efficiency, their advantages and disadvantages, both generally, and what that means for a lower income specifically, and then give you give you a sense of the experience of each of these financing products. And then at the end, as Warren and Samantha mentioned, we will have time for questions. So first, I want to talk to you about what is available in terms of financing products that are being used in the low-income market. And by financing products here, I'm talking about loans or loan-like products that building owners or renters might be able to use to pay for efficiency. So this graphic shows the world of financing products that are used to pay for efficiency in both the residential and non-residential sectors. This is for the entire world here. We split them into traditional financing products and specialized financing products. Now, the traditional financing products are very common. They're used to pay for all kinds of goods and services. And the products that fit into this category are unsecured loans, secured loans, and leases. The specialized products, on the other hand, on the right here, are designed specifically to address challenges to the adoption of efficiency and clean energy. In this category, there's Ondol financing and repayment, you see right under the specialized here. There's property assessed clean energy, financing or PACE, and savings-backed arrangements, which include energy savings performance contracting and energy service agreements, or ESAs. Now in a minute, I'm going to go into detail on each of these categories, and I'm going to start with traditional financing products, specifically unsecured financing. Leasing for efficiency is not generally used in the residential sector, as far as I know, so I won't be covering that. But I will explain what the products are and give the pros and cons for each in terms of efficiency and in terms of how they work for low-income folks. But before that, I want to give you at least a sense of the size of these markets. So here are some quantifications for efficiency investment in 2014 using different financing products. Note that all of these numbers are for all sectors. This is not residential. This is not just commercial, and it's not just low income. So in terms of the traditional products, we don't really know much about the size of that market in terms of investment for energy efficiency specifically. Unsecured loans are likely to be used a significant amount of investment, and leases also likely provide a substantial amount of funding for efficiency. mostly in the commercial and institutional buildings. Last year, my colleague Jeff Deason and I completed quantification of market investment in energy efficiency through some of the specialized products. So Ondol loans did about $179 million in loan volume in 2014. PACE did $267 million, although it was and is experiencing very rapid growth. And by far the largest is investment through energy savings performance contracts. Most of that is that investment is in public and institutional buildings. Energy service agreements we did not look at, but that is likely a small amount. Now let's take a look at the different financing products, starting with the traditional products. So unsecured loans. These are the loans for which lenders have no recourse to take possession of a borrower's assets in case of non-payment, in case they don't pay the loan back. Some examples of these are unsecured bank loans and credit cards. And because they're not secured by the building, that is, there's no collateral, non-payment can hurt a borrower's credit, but it doesn't mean that you lose your home or have your power disconnected, which can happen with some Ondol programs. And for many low-income folks who own a home, their home is the bulk of their wealth, and losing that can have multi-generational impacts. An example of a program that's using unsecured loans specifically for energy efficiency is the Warehouse for Energy Efficiency Loans, which operates in a few different states, but historically has done most of its lending in Pennsylvania. And about 23% of the study recently and found that about 23% of their participants make less than 80% of the area median income or AMI. So they are people who would most likely qualify for low-income programs. Now, the fact that there's no collateral increases the lender's risk of loss. And that means they're going to charge higher interest rates on these products. So these products are likely to require a subsidy to be affordable for low-income households. However, they are quicker and more accessible than secured loans. And so if you have a situation, for instance, if a heater breaks in the middle of the winter, you can't wait 10 business days to get a secured loan. An unsecured loan might make more sense. The takeaways here are that these are widely used products. They can be helpful for low income for doing emergency replacements, and they don't put a household's home at risk, but they're generally less affordable unless there is some subsidy, and so might require a subsidy to reach low-income households. So next is secured loans. These are also traditional. These are loans for which lenders may indeed take possession of a borrower's assets if the borrower doesn't pay, and the lender can sell that asset to reduce their losses on the defaulted loan. Some examples here are mortgages, commercial loans, home equity lines of credit. Now the advantages are that because of decreased risk of loss to the lenders can often offer these loans at lower interest rates and give longer terms, which translates into lower monthly payments. The takeaway there is that they're more affordable than other forms of financing for low-income households and businesses. And affordability can be one of the top barriers to efficiency, especially for low-income households. On the negative side, because of the necessity of valuing the home and placing a lien, they're higher transaction costs, and so they take longer to execute than unsecured loans and some specialized financing, meaning that they could be less attractive, particularly for reactive projects. And by reactive projects, I mean, for example, the emergency boiler replacement, or something breaks down and you're replacing it, as opposed to going forward with something that you've decided you want to improve that hasn't broken down. Also, as I mentioned earlier, homes are the largest source of wealth for a lot of low-income families, and securing a loan with a home means the borrower risks losing their home if they can't repay that loan. Now, several federal government entities have offered secured loan programs, for example, energy efficiency mortgages, which add efficiency project costs to a mortgage. But historically, the uptake has been modest. But the main points here are that they can be affordable, more affordable than other types of financing, but their longer turnaround might make them less than ideal for some types of efficiency improvements. And of course, they're only accessible to homeowners, which leaves out over half of low-income households, as we saw with Ian's presentation last week. And finally, it also puts a borrower's home at risk of being lost. So next, I'm going to talk about specialized financing products. Again, these are products that are designed to overcome some of the barriers to energy efficiency and some barriers to the use of financing, which I'll talk about later. The first one I'm going to talk about is on-bill financing and repayment. And by the way, on-bill financing is generally meant to mean products that use utility or public money to fund loans, whereas on-bill repayment uses third-party private money to fund loans. And these are loans to utility customers that are repaid on the utility bill. They're used in all sectors. An example is Green Jobs Green New York's on-bill repayment loan. It's primarily a residential program. It's traditionally had around a third of participants at less than 80% of area median income, so it's definitely serving low-income folks. And there are a number of advantages to paying for efficiency on the utility bill. For example, paying on the utility bill is familiar and is convenient. If a borrower is not sure how long they're going to be in the house, on-bill loans can be structured so that they can transfer to the subsequent occupant. So the original borrowers don't have to worry about continuing to pay off the cost of an efficiency measure that they're no longer using. They're often structured to be cash flow positive so that the average utility bill is less than it was before, even with the added loan payments. They also often use alternative underwriting. For example, an applicant could qualify for a loan if they have a good history of paying their utility bill, regardless of what their credit looks like. And if structured as, for example, the pay-as-you-save model, the PAYS model, it is not even necessarily considered a loan to the customer. So those that might be wary of taking on debt, they may be more willing to participate in a PAYS program. And anecdotally, that's the experience we've seen in at least 2 PAYS programs. They have the ones that have done a lot of volume with these types of products have usually offered below market interest rates, usually subsidized, and they've generally either allowed almost any energy-related improvements to be part of to be financed, or they've coupled it with on-bill with robust financial incentives and rebates. Some of these programs have been running for a long time, done over $2 billion in loan volume, with default rates between 0 and 3%. In 2014, they did, like I said, about $179 million in loan volume. The takeaway is that these products get at a lot of the challenges that low-income folks have to being able to afford efficiency improvements. Next, we're going to look at PACE. Property Assessed Clean Energy Financing, or PACE. PACE is a special assessment on a property tax that is used to pay for clean energy improvements, and it's repaid through the tax bill. An example here is used in both residential and commercial sectors, but an example that's mostly residential is Renovate America's HERO loan program in California, which has grown by leaps and bounds in the last few years. Now, since it's a special assessment, like a tax, PACE is attached to the property, and so therefore it can transfer. And in the case of a foreclosure, it would get paid off before all other debt secured by the property, including the first mortgage. So it's very secure, which decreases the lender's risk of loss on the loan. And this allows them to charge lower interest rates and set longer loan terms. and they might if they had less security. And this is important because it translates into lower monthly payments, which low-income consumers need to be able to afford an efficiency project. Some of the positives here are that because it's a special assessment, it's tied to the property, the payment obligation can transfer, therefore, just like a property tax would. So people don't have to be concerned about having to pay for the balance of the loan if you move. They also often use alternative underwriting, which for the biggest programs is based on publicly available information like the value of the loan applicant's building. And there are two big benefits here. First is this can allow folks with poor credit profiles or high debt to qualify for PACE loans. And second, since the criteria is based on publicly available information, these companies can get all the information beforehand, which allows for very quick approvals, which, as we've seen, can be very important, especially for low-income households making certain types of equipment replacements. On the con side, it's an unfamiliar product, which can make it difficult to understand the risks and benefits. Also, the available data suggests that the PACE assessments only transfer about half the cases where they could transfer. Another takeaway is that the alternative underwriting approach by itself doesn't necessarily assess the affordability of the loans, which is important for low-income folks. And then there's also the fact that one has to own a home to participate in this type of lending, and doing so puts your home at risk. There's been rapid residential growth. They've upgraded over 100,000 homes on the residential side, a little under 800 on the commercial side. However, the volume has been pretty concentrated. There's been rapid growth, but that's mostly, the residential has mostly been in California. And then over 80% of the commercial projects have been in California, Ohio, and Connecticut. So the last specialized financing product I'm going to talk about is savings-backed arrangements. These are arrangements in which a service provider takes on performance risk. And by performance risk, we mean the risk that the energy efficiency improvements don't work or don't generate the expected savings. And the two main types of savings-backed arrangements. There are energy savings performance contracts, and here energy savings companies, or energy service companies, excuse me, or ESCOs, directly contract with building owners to perform energy efficiency work. ESPCs often guarantee energy savings. Financing is obtained separately, but the guarantee could help with arranging that financing. Now, the other type of savings-backed arrangement are energy service agreements, or ESAs, and managed energy service agreements. And I'll refer to both as ESAs. I'm going to talk about them in a minute. I did want to point out that all risk mitigation is important for low-income consumers because they have a very small margin for error when they're taking on efficiency projects. I'll just mention quickly that ESPCs, they're mostly used in the MUSH market, but they have been used to make significant investments in multifamily housing and public housing in particular. Positive is that the ESCO guarantees that the customer will see a certain level of savings. They try to be conservative with how much they promise, and they're generally pretty good at it. So it minimizes performance risk. The ESCOs also provide technical support and operations and maintenance support, which can be crucial for low-income building managers. However, they're mostly for pretty large projects, and as I said, most ESPC activity takes place in the public and institutional markets. So it might be most appropriate for low-income multifamily housing and K through 12 schools in terms of how it applies to the low-income community. So while most ESPCs use financing to pay for their projects, they don't provide it, they don't furnish it, which is, although since most of them do use it, that's the reason we include them here. They don't provide the financing, so it does still leave open the question of how to pay for the project. Although the financing, as I said before, might be more easily arranged given that there's a guarantee on the savings. Then there are the ESAs. These are, ESAs are arrangements in which an ESA provider contracts with a building owner to oversee an ESCO's work and to furnish project financing. So here they are actually funding these projects. You don't have to go out and try to find your own capital for this. And they often guarantee the energy savings. They are often also paid from the energy savings, and this is important because it's a strong incentive for the ESA provider to ensure performance. They're mostly done in the commercial and institutional markets, but a few firms have been offering them in the single-family residential market. One with the most experience is Posigen, which operates in Louisiana, New York, and Connecticut, and they have told me that about 3/4 of their participants make less than 100% of the area median income, so capturing a lot of low and moderate income folks in there. Now, some of the positives for ESAs are financing upfront costs. It minimizes performance risk. You can expand access because they often use an alternative underwriting approach, which doesn't necessarily exclude you if you don't have good credit. However, they are unfamiliar, so like PACE, they could be misunderstood, and the alternative underwriting approach, again, might not demonstrate how affordable a project really is for a given household. They are complex. They can be complex structures, and they might not, like I said, they might not be that well understood. So next, we're going to look at market barriers to efficiency uptake and some barriers to using financing. There are a number of barriers that might keep low-income folks from investing in efficiency. Some financing product features can help overcome these barriers, but there are also some barriers to using that financing in the first place. The first is access to capital. Low-income households, by definition, have little income and usually little savings. So upfront capital costs for energy efficiency can keep them from investing in energy efficiency, even if over time the energy savings would save them money. Financing can take that upfront cost and stretch that out over a bunch of payments over time, a bunch of monthly payments over time, which can make it much more affordable. The next one is cash flow. Now, even though financing stretches the upfront payments out over time, the monthly payments still need to be low enough that a household can afford them and that they don't restrict the cash flow too much or at all if possible. Again, this can be a real challenge in low-income households. Then there are customer debt limits, and there are two here in the MUSH commercial and MUSH in the commercial markets, multifamily housing market. There can be other creditors that these entities have that may or may not allow added debt to be secured by a property. So that can be a problem. Some school boards, for example, might have to take increased debt to a vote. And in the residential sector, this can be, may sometimes be a problem. Some people are averse to debt, and some people may have sufficient debt that they are not able to secure more debt. If a household has too much debt, they might not qualify for a loan, like I was saying, for an affordable loan under traditional underwriting criteria. Then there are owner-renter split incentives. So if owners are responsible for paying their utility bills and would therefore reap the benefits of energy savings, there's little financial incentive for the landlord, that is the building owner, to invest in more efficient equipment or in efficiency upgrades. More efficient equipment is usually more expensive than standard equipment. Then there is occupancy duration. If a person's not sure that they're going to remain in a home long enough for an efficiency upgrade to pay back, they may not think it's worth it to invest in that upgrade. And finally, application process. Application processes can be sufficiently burdensome that they turn off some potential users to financing. Also, application processes may bar many less qualified applicants from accessing financing. So these are a few of the barriers that we see. Now, here are some examples of how financing can overcome some of the barriers that we just talked about. For example, with the customer focus on short paybacks. This is the cash flow problem. Financing that's structured to be cash flow positive could overcome this. If you have a loan that is structured so that the average bill savings are more than the average monthly payment, then that means that the household is actually saving money every month. They are cash in terms of cash flow, they are better every month, and so they may be more willing to take on a loan to do that, even if they were initially focused on short paybacks because of cash flow. Then there's uncertainty of occupancy duration. If financing is structured so that it can transfer to the subsequent occupant, then the borrower doesn't need to worry about paying for efficiency in, for example, in home A once they've moved to home B, because they know that the new occupant in home A will take over that loan and be paying for it, which is also a nice way to do it, because at that point that occupant is also going to be benefiting from those efficiency gains. And then finally, in terms of owner-renter split incentives, if owners can pass through or share repayments, they may be more inclined to make an efficiency investment. And one of the places we've seen some significant renter participation has been with the pay-as-you-save model, where it's an investment by the utility in energy efficiency at a particular household site. Those improvements are paid off on the utility bill in the same way that other utility bill charges would be paid off. And if the person moves, the charges would stay on the utility account for that site. So the landlord does not have to pay for it, and so may be willing to allow their renter to take on those improvements. Now let's look at these barriers in the context of different products we examined and in the context of different market sectors. So this is a kind of a key to the following two slides. In the next slide, looking at market sectors, if there's no circle, then this is a barrier that's not necessarily important enough to drive design of an efficiency program or product. If there's an open circle, then that barrier may be relevant, but not necessarily paramount in that sector. And then if there is a filled circle, the barrier may be especially important in that sector. Then for the following slide, looking at financing products, it's similar. No circle means that the product may not address that barrier at all. An open circle means that the product may address this barrier somewhat, or it may or may not address the barrier, or it may address the barrier somewhat. And then a filled circle means that this product is likely to be able to overcome this barrier. So here we're looking at 4 sectors: the single-family, low and moderate income sector, the multifamily affordable housing sector, the small business sector, and the municipalities, universities, excuse me, schools and hospitals, or MUSH sector. On the left, we have the different barriers that we talked about. So in terms of access to capital, this is a prime barrier for most of these markets. Access to capital could even be a barrier in parts of the MUSH market as well. For example, with K through 12 schools. Then cash flow and the focus on short paybacks. Cash flow tends to be a barrier for all of these sectors, although potentially a little less for small businesses and the MUSH sector. Then customer debt limits. Oh, one of the things I should have mentioned before is that these are not hard and fast rules, but rather they're our best judgment based on our experience and our knowledge of these markets. So, these markets are quite dynamic. For example, with the MUSH sector, we had to get it into sort of, we wanted to break it down into a single thing, but there's a lot of different types of building types within that sector. Same is true for other places as well. So there are a lot of differences that sort of push how accurate we're able to get. So next, the customer debt limits, and these I see that there's a mistake here. This should be, I think that this is most pronounced in the multifamily affordable market, but it looks like we've missed the dot there. This is most pronounced in the multifamily affordable market. It may be a problem for small business, and they can also be a barrier in the MUSH sector. Here, the thinking is that, for example, schools may have to hold a referendum in order to take on more debt, so the debt limit can be a barrier to investing in energy efficiency. Then the owner-renter split incentives can be a problem, mostly in the multifamily affordable small business, and also somewhat in single-family low to moderate income. There's a lot of ownership in single-family low to moderate income, more than I expected when I first started to look into this. And then finally, with the occupancy duration, we see that probably as somewhat of a barrier in single-family low to moderate income sector, multifamily affordable housing sector, and the small business sector. So finally, let's take a look at how the different products might address each of the barriers. So first, we've got access to capital. What we're looking at are the different products we've talked about here, the unsecured loans, secured loans, on-bill financing and repayment, property assessed clean energy or PACE, and then the savings-backed arrangement, the ESPCs and energy service agreements. So all financing is meant to help people afford an upfront cost and break that down over time. However, all financing is not equally accessible, and so on-bill with its history, use of bill payment history as a way to qualify applicants that's our thinking for why that one is more accessible than most of these other products. Then there's cash flow. Here, all of these can help with cash flow if you as opposed to an upfront payment. However, because of unsecured loans, high interest rates, and that one is probably going to be less affordable. Cash flow is very closely tied to affordability. Secured loans we have as being better with cash flow because these are lower cost loans in terms of interest rates, and they're longer term, so they break down the monthly payments to be much less. Similarly, PACE can have very long terms and help pay back quickly. The on-bill, I would say, the pay-as-you-save model tends to encourage cash flow positive projects and to use very conservative guidelines with getting to cash flow. So the PAYS model would probably be a more strong cash flow product. And then savings-backed arrangements, because they guarantee some performance that hopefully will be closer to cash flow, that's also helpful there. In terms of the customer debt limits, the on-bill PACE and savings-backed arrangements, these are specialized products that try to address this type of thing. Unsecured and secured loans are both debt. These others may or may not be considered debt, and may even potentially could garner some type of off-balance sheet treatment for small businesses and other types of places that are concerned with debt. Then the owner-renter split incentives. Here, in terms of the on-bill, as I was talking about, PAYS can be helpful with this, and also the on-bill can if it is structured to be cash flow positive, that can help. It is paid for. The investments are paid for on the bill, and so the landlord and owner is not having to pay in there. And then in terms of occupancy duration, on-bill and PACE, because they are able to transfer, are able to get directly at that barrier. And then finally, with the application process, the unsecured and on-bill type loans have probably the quickest turnaround, although certain PACE programs, particularly the big ones in California, like Renovate, Renew, they use publicly available data, and they're able to do very quick turnarounds as well. So within that, they could also be they could also get at this burdensome application process challenge. So I am going to leave it there. I will mention that in the next few months, State and Local Energy Efficiency Action Network, or C-Action Network, will be coming out with a report that I'm leading called Energy Efficiency Financing for Low and Moderate Income Households, which you may find interesting. For more information on efficiency financing, generally you can visit our website. I also have the website for the Clean Energy for Low-Income Communities Accelerator here. Also, after this page with contact information, I'm happy to talk with you, by the way, if you have any questions, and some of my colleagues who can also help. But after that one, I have also a page of sources that I used in putting together this presentation. So thanks so much to everybody for attending, and I look forward to your questions.
Hey, thanks very much, Greg. And these slides and a recording of this webinar will be up on the CESA website at cesa.org. We have gotten in a number of questions here that I want to ask. First of all, what are the drawbacks to commercial and industrial customers of taking on secured loans? Are there any drawbacks?
For commercial and industrial customers taking on secured loans, my understanding is that they do not like to do that. Part of the reason is some of them have debt limits that they don't want to mess with, or if they've taken out loans, you know, the creditors on those loans may have covenants that restrict them to taking on a certain amount of debt. The other thing is that this financing and these efficiency projects are oftentimes competing with other projects, and oftentimes other core projects that could be seen as more core business, or related more to their core business. And so, you know, taking on financing might not be, or taking on that type of debt might not be helpful for them. For small businesses, they oftentimes may not own they're oftentimes may be renting, and so they might not own their place, so they can't necessarily take out secured debt. But those are some of the problems that you might see. And I've also heard that just as a barrier to efficiency in some of the bigger companies, that they prefer to invest in revenue-generating projects as opposed to revenue-saving projects.
Okay. And you talked about on-bill financing. Could you explain again, are those loans secured?
Those loans are generally unsecured. Some of them will put an equipment lien, a UCC1 lien on the equipment that they finance, but they are generally unsecured. One of the programs where I know they do secure those is, or they have in the past anyway, is the TVA's Energy Right Solutions program. It's a program that does on-bill lending for heat pumps, and they run the program through their distributors, their retail distributors, and some of them elect to put liens on the equipment. However, you know, I don't think any utility wants to, wants to actually go out there and yank a heat pump out of somebody's house. So, you know, there are also some other differences between a UCC1 lien and something that's secured in property.
Okay. You talked about transferability in relationship to PACE, and you said that sometimes it doesn't transfer PACE loans. Why don't some transfer? And can a person who takes out a PACE loan for their home know in advance about whether they're going to have difficulty getting it transferred or not?
Those are great questions. So I'm not sure. The data that we have on that is somewhat sparse, and it does not go into why it would not transfer. I could tell you, I could speculate that at least in some of the cases, I would imagine it is that so I've heard, for instance, with Ondol, an Ondol program in Canada, they were telling me that that they heard from lawyers that anybody who is a lawyer for somebody buying a house is going to tell them you need to clear, that you need to have the seller clear that lien before you buy the house. Whether or not it's a lien for something that's actually going to be saving them money. So it could be that they may clear the lien in order to sell the house more easily, sell the house at all. But it has been, this has been a bit of a point of contention in terms of making sure that people understand how, what things are going to look like when they get to the point of selling their home.
Yeah. You talked about ESA providers, in effect, financing projects out of the savings they expect to get. How do they, for a residential project, how do they determine whether their savings goals are likely to be met given the strong influence that occupant behavior has on energy use?
Well, the one company that I'm familiar with that is doing this is Posigen, and they've most of their loans like this have been in Louisiana, and their guarantee is that they're mostly or have historically been a solar company, and they do leases for solar, and then they will do these energy service agreements for the energy efficiency. And if you elect to do energy efficiency with your solar, they will guarantee that your bill will go down. They have, as I understand it, they have a number of stipulations, and they also have, they have some QA/QC that they do. They make sure. I believe that most of the houses that they do have smart meter data, so they can be getting very, very granular data, and they are tracking that. If they see anything go wrong, they will go out immediately to the place and try to figure out what's wrong. If it's something wrong with their improvements, they will fix it. And if it is something, along the lines of what you're saying, where say they've taken on a board or something like that, then I think they get into a dispute about whether or not they are going to be held to the savings that they promised. I think that is how that works.
Okay. Somebody writes in and says, I thought that on-bill financing and PACE were similar. Why are their effects different with respect to access to capital and cash flow?
Well, so part of that is that the way Ondol programs are structured can be quite different. Some of them require a cash flow positive type of structure. Some of them only require a bill neutral structure, so that the estimated savings are going to be exactly equal to your bill payments. But some of them don't, and so it's not necessary that you're going to actually get a lot of savings depending on what program you're in. With the PACE program, these are much longer term loans, like 20 years, whereas with the on-bill loans, they're also shorter terms. I think that the average is around 7 or maybe up to 10, and so that's going to cause the monthly payments to be higher. In terms of access, just about anybody who's living in a place who has a utility bill can potentially qualify for an on-bill loan. Of course, it depends on whether you're a renter or not. But with a PACE loan, you need to own the home, and you do have to have some minimum equity in it as well.
Okay. You had said that unsecured loans are likely to have higher interest rates than secured loans. Could you go through all the different products that you mentioned and rank them from like ones likely to be most expensive for the borrower to least expensive?
That is really difficult, because the truth is that within each of these categories, you have a bunch of different, like I was just saying with on-bill loans, there are a bunch of different ways that can be structured. Some of them subsidize down to 0%, and some of them, let it go all the way up to market rate. Additionally, in different markets, there's a different, there are different sort of interest rates. You might find interest rates to be somewhat varying in different markets. I would say generally, secured debt will probably be, without any subsidy, will probably be your cheapest bet. After that, it could be PACE, given in terms of affordability in long terms, it could be PACE, which charges what I've seen generally higher rates than secured debt, but much lower rates than unsecured debt. In terms of on-bill, it's hard to tell, because, like I say, a lot of those programs are subsidized, and we don't know what the market rate that they're subsidizing is. And in terms of the energy-backed, the savings-backed arrangements, that's hard to tell. I've never really seen an explicit interest rate sort of associated with those. So my understanding is that they can be somewhat expensive, but I don't know what that's compared to, and so, like I say, it's really difficult to rank them.
Okay.
Per se.
Okay, that makes sense. Well, we're coming to the end of our time, but I want to ask a couple more questions that we have in the queue. And one is, what are your thoughts on a nonprofit being a third-party lender to pay for energy efficiency or energy generation projects?
Well, I think that this happens a good bit, but I guess I would need to know more about it. Would this be a nonprofit that, for example, is it giving a grant to the folks, or is it giving loans to these folks? And
well, I don't know what the person who wrote the question had in mind, but
sorry about that, person who wrote the question.
okay. And so then the last question is, and with on-bill financing, who provides the capital for the loans? Is it the utility, or is it someone else?
Well, they're run by different types of entities. You know, a lot of them are run by utilities. And when we generally say on-bill financing, we're generally talking about programs that are using some sort of utility capital or public funds. And that generally tends to be in the form of either ratepayer funds that come from a public goods charge that can be used to meet efficiency goals or to pay for clean energy. I've also seen utilities use shareholder funds to pay for these programs, but they also take on public funds. For example, the Regional Greenhouse Gas Initiative, RGGI funds, have been used to pay for, to capitalize on-bill loans in the Northeast. And the USDA's Energy Efficiency Conservation Loan Program, or ECLIP, is being used in a few places to pay to capitalize on-bill loan programs. In terms of third parties, there's also on-bill repayment, in which you have a third party, generally a bank or CDFI, that is a community development finance institution, like a credit union, for example, where they will put up the capital and work with the utility to get that charge back. And that happens in a lot of places. The TVA program I mentioned before, they work with a regional bank that capitalizes all of their loans. You know, it's being done in Georgia, Illinois. There are a lot of places where they're doing on-bill repayment as well, and that can get to, so the one perhaps challenge with the on-bill financing where you're using utility or public money is that it might not be sustainable. The utility might not have sufficient ratepayer funds to really scale a program, and public funds, their availability might not be consistent. Whereas with on-bill repayment, you're talking about private lenders who tend to have access to larger pools of capital. So looking at scaling, that might be might be where you might have to end up.
Okay, that's good. Well, Greg, thank you very much. This has been very helpful. You've given us a good sense of the lay of the land when it comes to energy efficiency financing, and we do hope and believe that folks who are interested in finding strategies for financing solar for low-income households and communities can take some of this information and see how it adapts to the solar arena. We will be having future webinars through the Sustainable Solar Education Project, so look forward to those, and thank you all for attending today.